Hello my fellow freedom builders and welcome back to the channel. Today we are gonna have a look at yet another small growth company that might turn into some sort of a rocket. The last 3, 4, 5 videos I have made of this kind have actually been hitting the stock spot on, and they have gone up quite a bit afterwards. So I'll see if I can keep up the nice streak right now. So today we're gonna have a look at something called Encore Capital Group. And as you know, I have a bunch of different scanners and screeners and way to look at the market and news, and sometimes a little gem pops up that I actually never heard of before, and Encore is just such one. And I can hear from many of you that some of the videos I'm making about small growth companies, that is companies you would never have been able to dig up yourself. So I hope this one is exactly such one. So let's have a look at what Encore actually is and why I have been taking a little position in it. I just bought a bit here around market opening today. Now, Encore Capital Group, if we look at what they describe their own business as, it is a company, a global specialty finance company with operations and investments across North America, Europe, Asia, and Latin America. So they are pretty much spread up out over the world. That is great. What they do here, Encore, through its subsidiaries, partners with individuals as they repay their debt obligations, helping them on the road to financial recovery and ultimately improving their economical well-being. Well, that all sounds very good, but what they actually is they are a debt collecting company. Meaning that, for instance, if we have a bank that has, let's just say $100 million in debt and they need to get them off the books, then Encore comes in and buys it at a discount. I'm not even sure how much discount that is. We could probably find that in the papers, and of course it depends on if it is purely junk debt or if it is high quality. But anyway, Encore comes in, they pay them some percentage of the entire debt. They could be, if it is really junk debt, they are paying 40 or 50% of the $100 million, or if it is high quality, they might pay 80 or 90% of the debt, and then they go out and collect the debt. So they are debt collectors, and what their business is about, of course, is to buy the debt as cheaply as possible from banks and other financial institutions, and then of course they need to be good at collecting them. And let's have a look at just some of the quick numbers here. They just had the numbers come out the other day, and as you can see, global collections second quarter 2020 was about $500 million. Global revenues, that was up 23%. Estimated remaining collections, $8.4 billion. I read this as that is what is on their books, so that they can go out and collect that. We can see their earnings per share, record net income, and so on. And of course, as always, I will link I'll link to this below so that you can read the material for yourself. When we're looking down here, we can see record MCM collections in Q2. We can see these are the Q2 in 18, 19, and 20. And here we can see the call center and digital, collection agency, and legal collections. And what we can see here is that they have been able to grow the part that is called call center and digital. I was digging a bit into that, and as far as I can tell, this is the part where they are actually doing stuff from the office. And now they have not been hit too severely by this virus in the world right now, because that they have been able to move more of the debt collection back home. So basically, this part is the cheap part. That is where one of Encore's partners or employees are sitting at home trying to collect the debt or doing it digitally. The collection agency is where they have some third parties in, and you can see that is a very tiny fraction of their entire debt collection. And then they have the big blue part here, the dark blue, that is legal collections. And that is, of course, the expensive part. That is the part where you have lawyers and court and so on. And as you can see, since they have been able to lower that percentage, we can also see that the cost to collect has been dropping dramatically. And that is, of course, something we would like to see. If or when we are buying into this Encore business, we want to see this collection cost to drop as much as possible. There's a lot of explanation about also what they have been doing with the virus here, and some detailed financial discussion. You can see here how much debt, how much deployments they have in different areas of the world, and you can see all sorts of stats here. I'll not go in depth with this, but just say that what I have been seeing here, it looks fairly stable. And one concern I could have, and that is around all of this virus crisis in the world right now, is of course if they have been buying a lot of debt where people are going out of business right now and they're not being able to pay their debt. But it seems like, as far as I can tell from Q2, that they have been able to solve that quite professionally without too much problem. Now, if we're looking at the chart, then we can see here that they have been in and this is the pure technical analysis on a weekly chart here. We can see that if we just go back in time, they have been, before they have been quite a good growth stock. From 09 to 13 here, over 4 years, they went from around $3 or $4 here and up towards $50. So that is a 12-fold in stock price. So they have done this before. They have been growing massively before, and they made in this time period, they were making a lot of acquisitions. And as far as I can tell, I was digging a bit into the history. There was a lot of complaints about them in this period where they were growing so quickly. And some of it was that they were a bit too aggressive when trying to collect the debt. And there were different issues. But as far as I can tell, that was up until 15. I have not been able to find some massive problems after 15, 16. Since then, the price have been somewhat whipsawing here. And what we can see, if we are zooming in, there have been a kind of an area here around $40 where it has hit a couple of times, 3 times, and then it moved up massively here the other day. Last week, that was on the earnings where they surprised very positively. Earnings surprise of 82% above what was expected on the earnings per share. And that made the price shoot up, and I suspect that what we saw here was some profit taking, or a lot of people that have been in the stock for a long while and being in the red. We are at the highest level now since August 18. So I suspect that a lot of people have been in the red for quite a while, and all of a sudden they are able to get out of the positions with a win, or at least just a small loss, and they are taking some profits. I was a bit, I've just entered 10 minutes, 15 minutes after the open today, and I just wanted to see if the drop kept going on, but it doesn't seem like it. So I went in with a small position, and I am planning another position if it moves up $1 or so to show that the buyers are really getting in. Now, let's have a quick look at some of their fundamentals. If we're looking at Stockopedia, you know, that is my favorite tool. There's a link to it below if you want to check it out. I think there's still a 25% discount from the company there. When we're looking at the earnings quality, it is not amazing score here, 58, not in the red zone, but I do like it above 70 though. But we can see that it is actually measured as a 92 in value and an 89 in momentum. The momentum we can see here, no doubt about that. So an overall stock rank at 97, which is kind of great. We can see that the overall market cap is just above 1 billion euro. So it is not a big company, as I said at the beginning. It is a small growth stock, and I am putting a bit of my money into these small growers to spice the portfolio up a bit. When we're seeing here, we have the PE ratio, which is very low, below 5, which is great. a PEG ratio at 0.3. The reason for that is that we have a low PE ratio and some great expected growth here on the earnings per share estimates for next year, 21.3%. That is great. When we look down here, price to free cash flow, price to sale, EV to EBITDA, all of them are looking great. We are having a Petrosky score at 6. That is also very nice. If we're looking at the earnings per share normalized graph here, we can see that they are going up just in the way I like to see it. That is almost a straight line drawn with a ruler upwards here. And as you can see, the estimates for 20 and 21 are still there. I suspect that the 20, that must be the yearly estimate, so they're not, it is still an estimate here. But it seems like they're keeping up with the projections for the numbers. And yeah, I like the numbers, and as you can see down here, great growth numbers, absolutely. It is a bit rare to see such sort of growth numbers and still see low PE ratios and so on. They tend to be bid up, but I think it's actually quite a fair price we're seeing right now. Free cash flow also growing just as I like to see it. There's no dividend. As we can see here, the net debt is fairly stable. They do have a lot of debt, and they are taking on debt to buy another debt, so they're quite leveraged here. So that is when they are borrowing cheap money to buy some debt from a financial institution and then collecting the debt. And it seems like a business model that is working quite nicely for them. When we're looking here at the estimates, you can see here for the revenue, the net income, the normalized earnings per share, that is going up. We can see that the six analysts that are looking at them, they are having it at a buy, tilting towards a strong buy. And we can also see that the estimates here are going up from left to right here. That is what we like to see. All right, so nothing wrong there. And if we're looking at the Guru Focus, we can see also the same picture. Many of these value models here, if you're working with one of these, if they are, if this bar is going further to the right than this dotted line, it means that this model tells us that it is a good value. We can also see that Guru Focus, let me just take this a bit to the right here. We can see that they're giving them 3 stars. And as I've been saying in other videos, it's not that I invest from this, but I do like these small growth companies to have some stars, because it means that there's enough value in here so that the Guru Focus model saying that we can expect a positive outcome over a number of years. When we're looking here, their financial strength is not amazing, and that is again because of the debt they're taking on. But the profitability is great and the valuation is quite fair. When we're looking down here, we can see, let me just find it down here. There have not been a number of insiders selling lately, so they're neither buying nor selling here. But we can see there have been a bit of guru activity down here, some buying and some selling, but it's not really a trend where we can say everybody is buying or everybody is selling. So Guru Focus, there's not really anything here that scares me away. When we're looking at the fast graph, as you know I like to, then we actually see quite an interesting picture here. Because as you know, the black line here is the price, and it has been going sideways for a while. That's the same as we saw here in the trading view here at the graphs here. But what we can see is that the blue line here is the normalized PE ratio here around 8.9. And when we look at that and we see the projections for the future, it has been hovering up and down above and below this blue line for a number of years now, and right now we're actually way below, and it indicates that there is some upside. And what I do like to see is that when we get these nice buy signals here, where we have the RSI above 50, we have a stock that does better than the overall market. We can time it here on the daily chart, but when we get a good buy signal here and a good trend, and at the same time we can see that this is very, very well priced compared to the historical development in earnings and PE, then I get more comfortable buying it. And if we're looking at the forecasting here, we can see that we are very low in this area. What I do like to see is that even if it just keeps at the current level, then we are not in for a massive risk. As you can see here, if it just keeps at this level, this PE level here, we can see that we will still over the next year and a half or so be making 14% per year. But if it just starts to occur to investors that this might be a bit undervalued and we're just moving up a set here, we are talking some really hefty percentages here of 50 or 70% per year if we would be to move up towards this normalized line up here. So I've got faith in this, and if we're looking at the analyst scorecard, and that is a good help to see if the estimates tend to hold through. And as we can see, there have been some major beatings in the positive direction here. Then we have had a long string of years where they have quote unquote just been beating the expectations by 4, 6, 7%. Then we had a really terrible year in 16. There was a bit of a negative surprise here in 17, but the last 2 years in 18 and 19, there have been some very nice positive surprises here. So the overall picture is that they tend to at least fulfill the estimates or go above it. And as we're seeing from Q2 here, it actually seems like they are on the path to beat the expectations for 2020 as well. So all in all, a very, very fair valued stock here with some very nice upside potential. If you're looking at the last one here for today, that is the SACs that I also subscribe to. What I tend to choose is SAC ranks of 1 or 2. And what SACs are looking at is not if it is a rock solid company, but a lot of their SAC rank is actually derived from the expectations, and then if they are beating or not beating the expectations here. As you can see, they have been beating quarter over quarter here. Then there was one single negative surprise here and then a positive surprise again. So overall, for the last couple of years here, there have mainly been positive surprises. As you can see here, the SAC rank description, that is a buy right now here. And they have some statistics here as to if you only buy the strong buys or the buys, what you would make on average here year over year. But that is another story. But a 2 here, I also can buy a 3 on the SACs rank, but I never buy 4s and 5 because there have been a lot of negative surprises there. So overall, what can we say? Well, it seems like they're having a good company here with some good fundamentals. They're making money. It is fairly valued, or at least or even low valued right now, with a lot of upside potential. We are seeing some a spike up here. The only thing, and that is on the short term, is that down day here. But as I said, I suspect that is due to some profit taking. And I've gone in with a very small position here for a start, and my stop is way down here. So there is some room for a retracement before I get sent out of the stock again. So of course, sometimes they go against you and we cannot always be right. But this is one of the stocks where I think we are stacking the odds in our favor, and there is a good chance for a further upside in this stock. That is my opinion. As I've said, the disclaimer, I have bought a bit of this stock and I'm planning to buy more if it goes up a bit. And you should always do your own due diligence, your own research. You should never trust a YouTuber and just jump on stocks on some random YouTube channel like mine. You can get inspiration. I hope you get inspired here. But as I said, I'm not a financial advisor, so never take my videos here as a buy or a sell signal. That's all for now. I'm hoping that you want to subscribe to the channel and like the video if you feels like that. And take care of yourself and your money out there. I'll talk to you again soon. Bye for now.